Welcome to Nasdaq TradeTalks, where we meet with the top thought strategists and leaders in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is David Waddell, CEO and Chief Investment Strategist of Waddell & Associates, Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk, as well as Maddie Radner, Director on Nasdaq's Market Intelligence Desk. And we're here to discuss how global markets compare to U.S. equity performance and the impact of U.S. dollar movements. It is great to have everyone with us. Welcome to Trade Talks. And David, before we get into how the U.S. is impacting other areas of the globe, thoughts overall, earnings recap, quite decent.
I mean, that's the big story, right? By the way, thank you for having me.
Of course.
So, we got double-digit earnings growth this year. We'll have it next year, potentially the year after that. I mean, we are in a huge tech upgrade cycle. Last time we saw one of these was obviously the internet, and we had a dozen years of 10 plus, earnings growth. And I imagine we're in that same zone, and it's not just large caps, it's mid caps, small caps, it's international, it's emerging markets. So we're in a great earnings period. So that should provide lift for the market over, a longer period of time. For the moment, I think maybe the rally season's over and maybe election season's upon us, and so the summer doldrums, like we talked about, maybe here. But earnings season was great, it was validating, and it should get better from here.
Right, and Maddie, we've spoken about this before, where the market's expectation was 6 to 7 rate cuts in the beginning of the year, and really it has touched all-time highs predicated on what we're seeing from the fundamentals, which for the most part, I think everyone agrees is encouraging. You don't want to get 6 to 7 rate cuts at this point because that signals something different.
Right, we don't want that.
But the data starting to soften, coming a bit.
Yeah, now that earnings season is over, all eyes are on any economic data that's been coming out. So it does seem like we're in a little bit more of a cooling environment. We saw softer jobs data, softer manufacturing data. Friday we'll see the May jobs report come out, and then next week we'll see CPI and PPI. So all this will hopefully help us determine if the Fed will begin repricing the rate cuts that we're expecting.
Right, and Brian, I want to take a look at this because you brought up something interesting on crude versus rates, and you noticed a pattern here. So let's pull up your first chart, and it's interesting how perhaps crude could be leading the rate story.
Yeah, we've seen over the last 12 plus months or so, a positive correlation with the, movement between crude oil and the long 10-year yields, and where crude oil seems to be 3 or 4 weeks ahead of the 10-year. And so in the last 5 days or so, crude has been breaking down about 10% from the intraday high to today's intraday low. And so we're beginning to see some weakness now on the long end of the curve as well. They both kind of made their recent highs in mid-April and been trending lower. So I don't think crude is going to be breaking down too much further. If you look at a longer-term chart, it looks like there's some technical support around $70 to $73. But if we look at the 10-year yield, that has been pulling back. It's now testing its 200-day moving average, and it's back to that 4.33, 4.35 level, which goes back to October 22, which was a high after a phenomenal 2-month move just from August to October, where it went from 2.5% to 4.35%, and then for 12 months it kind of traded in a consolidation range. And so more recently that's been a resistance level, and just last month a support level. We're testing it now again. So if we're seeing crude now kind of breaking down and making lower lows, if the 10-year does the same thing, wouldn't surprise me if we see the 10-year go from right now 4.3, 4.35 to maybe to the low 4% range.
Yeah. And David, we could take a pause in the markets here and start thinking about second half strategies, of course. And you had noted that the differentials between U.S. and non-U.S. markets are actually quite narrow.
Not only that, the dollar at one point was up 5%, right, which creates a drag on international returns for U.S. investors. The dollar has come back 2.5% from there. And so if you actually do the foreign markets in local currencies and their host currencies rather than translate through for the dollar effect, there's not that big a spread. I mean, outside of the NVIDIA composite, everything else in the world is up 5 or 6%, right? I mean, emerging markets are lagging a little bit, but you throw some currency adjustments in there. You look at the EFI, you take Japan in host currency, and it's the leading of the large markets. And so I think U.S. investors are such navel gazers, like we just love U.S. stuff, right? But in reality, if we've gotten to where earnings season is behind us, the macro picture is softening, and I think that's true. We've got the yields coming down, we've got commodities coming down, we've got oil coming down. That is a case, and you can see it in the Citigroup Economic Surprise Index, where the U.S. is surprising to the downside in terms of its indicators, while Europe is surprising to the upside, and we're going to get a rate cut out of them later this this week. So it may be that, like I said, rally season's over, we're in election season, and it's time for U.S. investors just to take the summer and go abroad maybe a little bit and take some international exposure over the course of the summer until the election's behind us.
Yeah, and it's interesting too because some of the companies and the themes that overseas investors are putting their capital towards really is around that tech, software, chip, and energy trade, of course, with AI and EVs and all these renewable energies coming online, you need to power it somewhere, right? So those fundamental reasons are largely the same overseas as well.
Well, and the consumers are perking up a little bit over there,
right,
and inflation's coming down, so it's giving them more real purchasing power. So it's just a place that most people don't talk about, they ignore it, but oh, by the way, it's trading at like 12 or 13 times, and we're trading at 21 times. So if you can get the same double-digit earnings growth over there, and you can pay 12 to 13 times for it, and maybe you get a little bit of a currency tailwind, that could be the surprise, I think, in the second half.
Yeah, and it's interesting, Maddie, because you follow the small caps in particular, and it's almost, a different story there because there are so many rate sensitive sectors, and they, it has been a little bit, the small caps just haven't been able to get off the starting line.
Yeah, it's been a little bit muted, at least over the past couple months. I mean, they were one of the best performing groups at the end of last year. And then that was when the market was pricing in 6-7 rate cuts. But as that story shifted, small caps have kind of performed fairly flat year to date. They've traded in a range between plus 10, minus 10, so fairly range bound since the start of the year. And again, they are a very rate sensitive group, so we are still seeing financials, real estate, even healthcare now kind of get hit so far this year.
Yeah. Brian, well, let's take a look at the DXY, right, from a technical perspective, the index for the dollar.
Sure. The DXY, it's been trending lower. It made its recent high back in April, and this week, yesterday it broke down back below its 200-day moving average. Just a week or two ago, and then a month or so ago, that was the low on pullback. So it's breaking down below that. I think it's kind of around at a key level here around 104.25 or so, 104. And if that were to to break down, we could see on this weekly period chart that maybe there's a little bit more downside price action. This is about a 5% range from where we've seen the DXY trading in over the last year plus. And so if it's going to be heading down towards that level, I do think, like David was saying, that maybe overseas this would be a perfect time. Look at the emerging market ETF. This is based on the MSCI. This includes China, but it's just recently in early May did break out from a 2-year range. It's now pulling back the last few weeks. It could be the retest of the prior resistance level, and this would actually probably be a good time to, from a technical perspective, maybe you can see some attractive risk-reward levels here to maybe enter in on the long side.
And the FXI is up as much as the S&P now year to date too, which is kind of surprising. So China sort of snuck back into the leaderboard, capital moving there.
Well, I mean, it's interesting too because I'm looking at your notes here. If you go back to 1974, when the dollar is lower, you do see equities tend to outperform, not even just in the U.S., but you're seeing leadership in emerging markets as well.
That's right. So a lower dollar tends to be good for everything.
Right, right.
So it's good for the U.S., obviously, because our stuff goes on sale and other people can buy it. But it's good for the international returns because they get the currency translation effect. So lower dollar would be fine. We're good with that. And again, from a range perspective, we could, where were we, down at 80 or something at the end of 2023? So we've been at 104, kind of is where we are today.
Correct.
And we've been
down to around to 100.
Yeah. So if we got to 100, that'd be great. That'd be a nice little tailwind overseas because you just tack on 4% to what you own overseas.
Right. Especially if you're in the expectation that we should get some cuts or rates should come
Yeah,
down.
and
Even if it's the end of the year, I mean, I feel like that's going to start to be priced in.
Well, we're running dual deficits,
Right.
and we've got a lot of Treasury issuance coming to bear. So there are reasons to consider weakness in the dollar is appropriate. It's very hard. It's kind of a widowmaker trade. It's hard to do currencies because there's so many underlying inputs. But the trend is your friend for now, which is good for us.
There's like one massive one that works out every 20 years.
Yeah, exactly. Somebody
20
gets very rich.
Yeah, well, they get very rich. That's for sure. Do you think election volatility has been priced into the market at all? Is it too early to tell?
I really don't. I mean, the debate happens, June 21st? That should be something like that, is that right? something like that.
Between like 17th and 26th,
Politics
those numbers.
not my forte.
Yeah. But obviously, I feel like the verdict was kind of the starter pistol on the election season. And, walking around New York today, there are people protesting on both sides, all sorts of things. And so feels like it's heating up, and that may become a bit of a distraction. And somebody asked me to really lay out the candidates' economic and plans, and I have no idea what they are.
Right. Well,
Do you?
it's hard to discern what policy is, because I remember even going to the 2016 election, they had ETFs, like red ETF,
Yeah,
blue
that's
ETF,
right.
and based on policies that they were talking about, these are the bucket of stocks that should, in theory, do well, depending on which candidate got in. It's really tough to tell what
and
policies are on the table.
And does it really matter? Because if Congress is divided, it's not like any major legislation is
Right.
getting through anyway. So typically in election season, you see a 14.5% drawdown, and then once the election passes, you see a 27% melt up over the next year. I don't know that we'll see that. Today's another example of how every dip seems to be bought. So
Right.
I think it's just kind of a sideways summer, and again, maybe go overseas.
Yeah. Well, Maddie, let's talk about the IPO market. You said you're expecting some improvement into the back half going into the election. What are some bright spots?
Yeah, I was going to say, even with the upcoming election, that's not stopping the IPO market. If anything, we're seeing the window open up a little bit. The floodgates aren't going to come, but we're seeing IPOs kind of trickle in at a faster speed than we've seen so far this year, starting with Waystar at the end of this week, which will be the first US-based IPO, the biggest US-based IPO so far this year. Most of them have actually been domiciled outside of the US. We've seen a pretty strong sector rotation across IPOs this year, so it's looking good for the back half of the year.
I think it's interesting that dual listings is coming into. In fact, just before this roundtable discussion, we had a company from the Caribbean on that is listed on their home exchange, looking to list on Nasdaq for. Well, explain to us, what does increased access across multiple exchanges offer these companies?
So these companies will see increased access to additional investors here in the U.S. Also, just simple terms, additional trading, as their stock is now able to trade on the foreign exchange as well as U.S. hours from 9:30 to 4 p.m. So some of these stocks are seeing round-the-clock trading. So just extra liquidity, volume, and access to capital and investors here in the U.S.
Credibility.
Yeah, and that's the whole thing too. The marketing aspect of it as
Yeah.
well.
Yeah.
So you're
Right.
listed
Yeah,
on
you're really accessing a deeper pool of investors.
Yeah.
Right.
And so, this year to date, we've already seen companies raise over $16 billion. Waystar on Friday alone is going to raise over $1 billion. Last year, for the full calendar year, was $20 billion total. So the number of IPOs haven't been as strong, but the amount of raises have been good. So we actually are on pace to have more IPOs versus last year, but we haven't really had that, that escape velocity like we saw in 2020 and 21 when we were doing, 350 in 2020 and 21 we did 750. Those were a lot of SPAC IPOs as well.
Right.
SPAC IPO market has not rebounded. We're doing about 2 of those a month here at Nasdaq. So we used to have
That was an anomaly.
a much stronger pace than
in
that.
2020.
And we're certainly not short liquidity, right?
No.
Money supply is growing again. We got $6 trillion in money markets. Buybacks are happening. There's tons of cash around.
Right.
Yeah, and as far as the election goes, I don't think whichever party wins is going to be a concern that the deficit fiscal spending is going to go away. So
Right.
I think
You know?
I don't think.
And the
so.
ironic thing, that's like the one thing that you can count
Weak
on.
dollar.
You could certainly expect that, maybe there's a difference in magnitude from one versus the other, but
Well, yes, let's just, playing devil's advocate here, there is no roadmap for what an economy looks like coming out of a pandemic. Certainly in the past 100 years or, modern times with how, current market structures and so forth. So we're kind of learning as we go along the way as well. So we're only 4.5, 5 years out. So it's not like there's a roadmap where we compare it to, like when we think about what's happening with the AI trade, does it look like the late 90s, early 2000s? There's really nothing in modern history that we can compare the exit of the pandemic economy to. So, not that gives anyone a pass, but I do think that's part of the calculus
Feels
as well.
like we're starting to normalize.
Right, it does.
Which is nice. The deficit is not normalizing, right?
Right.
And it's got structural problems. The rest of the markets, I feel like we're normalizing a little bit. Wouldn't it be nice to get back to normal, right?
Well, but the whole
And
thing
we're
is,
getting closer.
When you think about rates, again, taking away inflation, the cost of goods from 2019 to where we are in 2024, but when you think about rates, particularly with mortgages, historically they're in where they should be, right? But we got over the past 10 to 15 years so used to near zero interest rates and so much liquidity in the system and short-term memories, short-term.
Yeah.
So maybe this is the new normal and how people have to get used to thinking about rates.
Well, and we were suppressing long-term rates. I mean, the 10-year Treasury should be the rate of inflation plus real GDP. So GDP now has come down to about 1.8, right? You've got inflation ex housing at 2.2, right? So when you start adding it together, it makes sense for the 10-year to be coming down a little bit because things are softening. So they make sense. There's nobody's their thumb on the scales the way they had during quantitative easing, right? So this is normal.
All right, and we'll leave it at that. A normal note. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.